The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Dip buyers disappear. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Bailey Lipschultz. We're kicking you off to the closing bells here in the U.S. Katie, we started in the green and drifted lower. We're trading at session lows, down 0.4% on the S&P 500, down more than 9% now from that closing high. So we are back on watch for correction territory on the S&P 500. Looking at 10-year yields, 4.34% there. Also keeping an eye on both crude and Brent. Looking at WTI right now at $103 a barrel. Brent north of 110. Katie, this is back, and it's always kind of been oil's market since the initial attacks on Iran, and it continues to be. We are now finally seeing that divide continue to play out, where if oil is higher, U.S. benchmarks are lower.
Yeah, it is oil's world, and we are just living in it. Let's check in with the sell side, because strategists over at Morgan Stanley are saying that the S&P 500 correction is nearing its final stage, even as the war in Iran continues. The Mike Wilson-led team notes that more than half of the Russell 3000 stocks are down more than 20% from their 52-week highs, suggesting that the market is pricing already those risks from the Middle East war. But the biggest risk to equities, they say, would be an interest rate hike from the Federal Reserve. But if you take Fed Chair Jay Powell's word at face value, that won't be too much of a concern. At an event at Harvard today, Powell said that longer-term inflation expectations appear to be in check, despite the Federal Reserve continuing to carefully monitor the situation in the Middle East. Now, Powell praised the Fed's current monetary policy for putting the FOMC in a good place to wait and see, and didn't seem too concerned when it comes to the energy markets.
Energy shocks have tended to come and go pretty quickly. Monetary policy works with long and variable lags, famously. And so by the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone, and you're weighing on the economy at a time when it's not appropriate.
Now, despite the Iran war brush off from both Powell and Wilson, the conflict has led to boosted oil prices and has driven stocks towards their worst month since 2022. WTI crude has now also breached the $100 a barrel mark alongside Brent, as Bailey mentioned. President Trump today repeating threats on social media to destroy Iranian energy assets if the Strait of Hormuz isn't reopened soon, leading to more questions about how long the conflict will last and what the broader implications could be. Let's unpack it all with Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. Jason, it's great to see you.
Thanks for having me, Katie.
So there is a lot to unpack there, as I mentioned. But, I mean, you think about just today's action. We had a very ugly end to last week. You did see some dip buying impulse when markets opened this morning, and it just sort of deteriorated throughout today. When you take stock of sentiment and all the different cross currents, how are you feeling right now?
Well, I think we need to separate sentiment from reality. Sentiment, first and foremost, this is an environment that causes investors to be tense. It should not be a surprise to any of us that when there's a war going on in the Middle East and disruptions to supply chains and oil in particular, that we're going to see some market volatility. Now, let's also turn to reality, because there's a lot of ways to model out the impact of higher oil prices. And at about $100 a barrel oil, our estimate is the impact on the U.S. economy is only about 0.2 to 0.3%, and the impact on inflation is only about 0.5% to 0.7%. So those are numbers that shouldn't be, when you're running at 2% plus growth, those are the sort of numbers that derail things. Now at $150, $175, they become more significant and a bigger impact on that growth. And I think where investors really should be concerned, but at these sort of levels at $100 a barrel oil, it's actually something that we can actually make it through. We just got to get past this period of uncertainty and sentiment that we're going through and get on to the reality of the situation.
Well, that's the thing, Jason, because it seems like that sort of ceasefire, sort of good vibe that was out there in the market, that's fading fast. Now the questions are becoming, how long will we see the Strait of Hormuz effectively closed? How many hundreds of barrels of oil are we going to lose throughout this conflict, which again brings us to the duration of things. So we're nowhere close to 150, 175 right now, but I mean, do you have to start modeling for that now?
I think you have to think about it. The magnitude is the question on oil and the disruption on the other channel. We haven't even talked about the Suez Canal and the Babin Mandeep, I can never pronounce that one right. If you talk about that channel, that's where a lot of European to Asian trade flows. We're seeing that maintain where it is. So right now, we're very much focused on the Strait of Hormuz, where energy is primarily the channel going through there. And the reason we're all focused on $100 versus $150 a barrel, at the end of the day, we find it very difficult to predict geopolitical events. In fact, quite often, the people that are actually in the flow are not those sitting in our seats. So we have to kind of think about this investment-wise from a perspective of we don't know, and we're not going to know when that switch is turned on, switched off, right? We simply need to take an approach of managing the risk around it, rebalancing appropriately, and positioning our clients for where it will likely be 6 months, 12 months, and even 2 and 5 years from now.
Well, with that in mind, then, at what point, as this war, as this conflict carries on, will markets be willing to look through it? If you think back a few years ago when Russia invaded Ukraine, it seemed like the sky was falling. Obviously, that is terrible, but the market kind of got around to that being an event.
Markets and investors are two different things. So markets will probably take time to actually see the realization of the stabilization in order to move on. Investors, though, when you see these disruptions, when you see the pullbacks in the markets, investors need to start chipping away and rebalancing portfolios. It doesn't necessarily mean that you rebalance 100% on just the first downdraft, but you do take those incremental steps because your portfolio is probably out of position with where you wanted it to be with a market that's down 8%. Maybe you move part of the way back and then take another move 2 weeks or 3 weeks from now and gradually rebalance in so that you maintain a position that's in line with your longer term targets.
Well, you mentioned being down 8%. We're now down more than 9% from that closing high. If we get into a technical correction, I know that's a big deal for us in the media. We like to write about it, but what do you make of that if we do reach that level?
Technical corrections are fairly normal things. We see 10% plus corrections in the market on average about once to twice a year. So when we see that, that is not necessarily the end of the world. That is simply the way markets behave and an indication typically that investors need to rebalance. And it's one of the reasons that we think about this from the perspective of will this derail growth? And those magnitudes I was talking about before, at $100 a barrel oil, even if that stays around for a while, that is not enough to derail economic growth in the US or even in Europe where the economy is more impacted. $150 plus, that's where we start to get a little bit more worried, and it would still have to stretch up a little bit above those levels for us to be overly concerned. We came into this year thinking this was going to be a pretty strong growth year for both earnings and for the economy. So we have a little bit of buffer to work with, starting point, before we actually ended up in this situation.
Well, Jason, before we let you go, I'm curious to hear what you make of the bond market's action, because yields, it feels like, have been going straight up. And then over the weekend, it feels like we switched to fears about growth. And you're seeing that expressed in a big bid into the bond market today. Do you think that that's premature?
I think the initial reaction we saw in the bond market was pretty much spot on with our expectations. When you hit $100 a barrel oil, to see inflation numbers for the next year that are up 60, 70 basis points from that, to see a bond market reaction where yields went up in line with what we've seen was actually spot on. Now, does that mean that's where it's going to settle out long term? Probably not. Similar to the equity markets, if we see things resolve, bond markets will settle back down to a more reasonable level. And we started there because of that reaction to inflation expectations. We'll probably end up at a more reasonable point longer term.
All right, Jason, great to kick off the week with you. That is Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. Now, coming up, with the president threatening key Iran energy sites if a peace deal isn't reached, we'll discuss the broad implications to the oil markets with Rebecca Babin, senior energy trader at CIBC Private Wealth.
Then we'll focus on another segment of the markets making headlines, the tech space. Dan Niles, founder and portfolio manager at Niles Investment Management, discusses where he sees opportunity.
And we'll talk about how this all fits into the inflation picture and what that means for the Fed with Esther George. She is former president of the Federal Reserve Bank of Kansas City. All of that and more coming up. This is The Close on Bloomberg.
U.S. oil settling above $100 a barrel for the first time since the Iran war began, as President Trump threatens escalation in the absence of a ceasefire deal. The Group of Seven, or G7 countries, saying they stand at the ready to, quote, take all necessary measures to stabilize global energy markets. Joining us now to break it all down is Rebecca Babin. She is senior energy trader at CIBC private wealth. Rebecca, right now I'm looking at crude north of $104 a barrel. It seems like the volatility keeps carrying on. What do you make of the current backdrop, and what are you watching?
So I think the thing I'm watching right now are three things. First, we did see the Houthis enter the conflict on Friday. And this is something that's important in terms of when we think about the flows that have been directed away from the Strait of Hormuz, they are flowing through a pipeline that lands them kind of in the Red Sea. Previously, the Houthis have been able to target the Red Sea and restrict flows. This happened in 23 and 24. So if the Houthis escalate in this conflict, they have a meaningful ability to actually kind of put more pressure on the market. They will move from a chokehold in Hormuz to kind of a stranglehold where even the flows that we're able to reroute now cannot escape. So I'm watching that as a key kind of variable for the market. This hasn't happened yet, but the fact that they are starting to engage is something I think is critical. Obviously, the rhetoric that we saw this morning from the U.S. administration about negotiations on one hand, but potentially, targeting energy infrastructure should they fall through, I think was a catalyst for some volatility today. So I think those are the two critical things. And then the last critical thing is just looking at the barrels. How many barrels have been impacted so far? The number goes up every day. We're looking at 300 million barrels so far in this conflict that have been impacted. We had some levers in place, some buffers. Those are starting to get exhausted. So each day that goes on, just got to keep kind of counting those barrels and figuring out how low inventories are going to go by the time the Hormuz is reopened.
But Rebecca, with that in mind, I would have expected oil to be up more today. And this morning, when we saw President Trump trying to talk down the market, we actually saw it trade in the red briefly. Are you surprised by today's action?
So I think we have been pounded by a barrage of headlines, and I think traders are getting used to the idea that maybe you can't chase every headline. So I'm not surprised that we're not up more because we have this back and forth. We take one step forward, we take 5 steps back in the rhetoric. Again, I think there's the more focus on the barrels. And one place where we have seen a little bit of respite is an increase of barrels through the Strait of Hormuz as Iran has started, charging some vessels to go through. So maybe that's offered a little bit of a release valve. So I'm not terribly surprised that we're not up more. And I wasn't surprised to see us down a little bit. It's the type of situation where traders have been so whipsawed that taking the bait on every single headline doesn't necessarily work. Looking at the barrels, looking at the actions as opposed to the words has been a little bit more productive.
Well, I am curious to hear your thoughts on a conversation we had with Amos Hochstein on Friday on The Close, a former advisor to President Biden. And he made the point that you take a look at energy markets right now, they're pricing in risk, but they're not pricing in disruption. And in his view, that was a mistake. And I'd love to hear your perspective on that. What is this market pricing in? And should we be thinking about worst case scenarios?
Okay, that is a great question, Katie. And let's start with this, that it depends where you are geographically if that statement is true. If you're sitting in Asia right now and you are buying physical barrels from Oman or Dubai, you are already paying $150 a barrel. So there is the risk because you have supply scarcity. If you're sitting here in the US and you're looking at WTI, which is above 100, you have to think about how we came into this conflict. This might not be the wrong pricing of risk. It might be that we had a good set of buffers coming in. We were anticipating oversupply in this market of 2.5 million barrels a day. We had high inventories. We've had the luxury of the SPR being here. We had floating storage at kind of record levels from Russia and Iran. So there were a lot of little pieces in place that helped insulate, let's call it, Western markets that Eastern markets didn't have. And I hate to use this example, but if you think of like COVID, it started in Asia and we kind of watched it from over here and said, that doesn't look good. And it kind of migrated and hit here. And that's kind of like how the price movement is going to come through really high prices in Asia. And they'll filter through to here over time as Asian markets try to suck out all the barrels they can out of the Atlantic basin and then come for the barrels in the US.
Well, that's actually exactly where I wanted to go, Rebecca, whether or not, the fact that we are seeing $150 per barrel in Asia, whether that's a leading indicator for what we're seeing on WTI. And if you do think of it that way, what is the typical time lag? When might you expect to see, WTI bump up, maybe not quite 150, but starting to get towards that trajectory?
So you nailed it. It's time, right? So I think if the market can start seeing barrels moving significantly through Hormuz by the end of April, we don't see 150 in TI. We have enough buffers in place. There's enough rerouting that's happening, assuming the Houthis do not start to target the Red Sea. I think the market has priced in this window to the end of April of seeing the barrels start to move, where we won't see that kind of convergence higher. We would see the convergence maybe lower with Asia gravitating towards Brent or TI eventually. So the longer this goes on, the more likely we converge higher to the Asian markets. If it can be nipped in the bud, they will converge lower to Brent and TI. So if we can't get through this and we don't see flows starting to really pick up at the end of April, I think that's when you start to see the re-acceleration to some higher prices.
Yeah, it's going to be fascinating to see how all the different lines come back together. Rebecca, always great to speak to you. That is Rebecca Babin. She is senior energy trader over at CIBC Private Wealth. Now, coming up, shares of Meta, they're higher on the day, but down on the month, heading for their worst monthly performance since October 2022. We'll take a closer look at the stock up next. This is The Close on Bloomberg. All right, it's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And we start with Expedia. Jefferies issuing a first-class buy rating for the online travel company and boosting their price target to $300 from $240. The analyst says that the pullback in internet stocks due to AI disruption concerns has created an attractive buying opportunity. Shares higher by about 0.5%. Up next, Starbucks. BNP serving up an underperform rating for the global coffee chain, along with a price target of $84. The analyst believes that there is a high degree of execution risk for new CEO Brian Niccol's turnaround plans. Shares down slightly on the day. And finally, Qualcomm. Goldman Sachs is dipping further into chips as they initiate coverage of the semiconductor maker with a neutral recommendation and a $135 price target. Firm is hedging their rating due to headwinds hitting Qualcomm's smartphone business. Shares also a little bit lower. And those are some of our top calls. And let's stay in the tech space and take a look at shares of Meta. They're popping on the day, but down around 17.5% this month as fears of heavy spend on AI can begin to concern investors. Joining us to discuss is Mandeep Singh of Bloomberg Intelligence. So let's start with the big red number, and that is Meta's terrible monthly performance, I believe the worst showing since about October 2022. What do you make of the different headwinds hitting Meta right now and that big fear around just how much they're spending on AI?
Yeah, look, I think everyone has been questioning their CapEx spend. You know, this year they're going to spend $135 billion, and they don't really have a model to show for that in terms of where frontier models are, Gemini, Anthropic, and OpenAI. So Meta is nowhere on the leaderboard. You can't really see their token consumption, which is a key metric. And on top of that, they lost these two lawsuits where their platform safety is being questioned. And I expect maybe there will be more lawsuits because, this is something that you're seeing regulators take a closer look at. It has been banned in Australia for under 16 users. So clearly there are things that are going against them when it comes to platform safety. And Section 230 shield isn't really helping them here.
Well, let's meditate a little bit longer on the spending point, because when it comes to Meta, in some ways, I'm having deja vu. You remember, how much money they burned on the metaverse that led to their stock being down 64% in 2022. And then they had their year of efficiency where they said, we're going to really trim back, guys. And the stock was rewarded in a big way. And now you fast forward a couple of years, AI is the hot thing, and they're just shoveling money at it.
Well, I mean, the good thing for someone like Meta is the core business is like a 60% plus incremental margin business. So they turn out so much free cash flow that they should be investing. The problem they have had is they spend $90 billion plus on Reality Labs and Metaverse, and they have nothing to show for it. Hopefully, that's not the case with LLMs, because clearly everyone of their peers are investing big in AI infrastructure. It's just the monetization and return on LLM spend is not showing up yet, and that's where they've shown they are nimble, they can course correct quickly. So, as long as the core business is strong, which it is, I mean, the addiction lawsuits kind of create that concern that maybe they may have to do more on platform safety. But again, there's nowhere else that people are going. They're still spending, a large portion of their time on Instagram and Meta apps.
At what point, though, would you want to see AI agents start to pay dividends? Is this something that the market's willing to give them a year, 6 months, 3 months?
Yeah, I mean, look, $135 billion in CapEx. If they really want to raise the CapEx for 2027, you want to show something that's comparable to, what Claude has done or what OpenAI is doing on the enterprise side. And that's the other challenge for Meta. Meta is more focused on the consumer side. We know Google obviously has done quite well on the consumer side. So where does Meta fit in? And when things like this happen in terms of the lawsuit that they lost, it's very hard to create an ecosystem. With LLMs, it is about, one, having the model intelligence comparable to other models, but also creating an ecosystem. And I think that's where Meta's challenges are quite pronounced. Like they can't really create an ecosystem when everyone is concerned about, the platform being safe enough.
In about 15 seconds, very quick here, reports coming out that they're testing subscriptions on Instagram. Is that a lever that the company realistically can pull?
Yeah, I mean, the agentic distribution will happen through Instagram and Meta's family of apps, and they could roll out a subscription. The problem is they didn't really have a good product yet to, roll that out through that distribution. So that's what I'm looking out for.
All right, Mandeep, always great to see you. That is Mandeep Singh of Bloomberg Intelligence. And coming up, we're actually going to stick with Meta and the tech trade in our upcoming conversation with Dan Niles. He is founder and portfolio manager over at Niles Investment Management. Why the Mag 7 name is one of his current favorites. This is The Close on Bloomberg. Just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld.
And I'm Bailey Lipschultz. We're looking at a market that is trading near session lows right now, Katie. S&P down 0.75% and heading towards, dare I say, that correction territory.
Yeah, and I mean, you think about just how ugly the month of March has been for the broader market, but within that, particularly for tech, which is curious.
Yeah, looking at big tech in particular and looking at infotech and the premiums that used to be ascribed to the likes of NVIDIA and Apple.
Yeah, definitely. You can see that premium that you talk about has all but evaporated this month when you compare PE ratios of just the technology sector to the S&P 500 overall, which, again, is very interesting because it might have been unintuitive to some that it's tech that's been hit the hardest. So let's discuss what exactly is going on with Dan Niles. He is founder and portfolio manager over at Niles Investment Management. And Dan, we have a lot to talk about here, but I do want to start with tech, the drawdown that we're seeing. I wonder what you think is behind that. Is it just that tech had the most room to fall after the run-up that it had, or is there something more foundational there?
Well, I think it's more foundational. It started in late October where people started to question the kind of stimulus for this AI trade, which was OpenAI. Because remember, they have 1.4 trillion in capital commitments over 8 years, but their run rate revenues is 20 billion. How are you going to fund 1.4 trillion? And then recently, you've seen them actually step back from some of the deals they had. Most notably last week was Disney. And if you remember, they launched their video generation app, Sora, to great fanfare. And then they struck that deal with Disney, where Disney was going to put in $1 billion into OpenAI. And then, OpenAI said, okay, we're not going to do that anymore. And that follows them not developing checkout for PayPal as well, as they say, we've got to focus on what we're doing, which kind of speaks to the fact that they've got a lot more pressure on them. And that's just one example of this.
Yeah.
But I think it's the most notable because, ChatGPT really started this whole AI trade in late 2022.
Yeah, and it's wild to think here we are in 2026, and that has been the defining narrative of these markets for the better part of that time. But you think about the sector as a whole when it comes to tech. Do you think that there's further re-rating to be had at the industry level, or are we, pretty much approaching the bottom?
Well, I think it's sector by sector. I think in software, we're nowhere near the bottom because it's really, you could say, since Mark Andreessen put that piece out in the Wall Street Journal back in 2011 of software eating the world, it's been, 14 years of straight up in software. Well, AI is going to eat a lot of these software companies alive. And so you haven't solved figuring out who the winners are and losers are in 5 months. And so I think software as a whole has a lot further to go down. Now, if you step back from that and you say, well, what else is going on? A big positive development is agentic AI, and I think OpenClaw has captured everybody's attention. And that kind of got finalized at the end of January. The original version came out at the end of November. And if you look at the amount of tokens being used by agentic AI, it's 10 to 100 times more than if you're just doing a chat-based question, right? So because then you have to go off and do a lot of things, go to different sites, create your spreadsheet, go to different sources, move things around. And so it takes a lot more computing power, and you can see that in the data. And so it's going to take some time, but I think as you get towards the end of the year, the companies that help power that are going to see their stocks start to move again. And the analogy I would draw is what we're going through right now, I think, is akin to what Cisco went through in 1997 and 1998, where if you go back and you look at that, in 1997, Cisco stock at one point during 1997 was down 37%. It finished the year up 31. If you go to 1998, at one point it was down 38%. It finished the year up 150. So you're going to get these questions on, have we reached the peak? Have we reached the top? And Cisco was kind of the NVIDIA of its day, the most valuable company in the world at one point, the internet infrastructure provider. And so I think you're kind of going through a similar situation right now, but agentic AI, which we've been sort of waiting for 3 years, OpenClaw being the best example of that, is showing that there's some value to this, and this is the next phase higher.
Well, Dan, I want to look at semis right now. Philly Semiconductor Index had been hanging in there. Right now, it's down about 11% in the last 3 days. Is that an area that you would feel confident putting money to work and trying to buy some of these dips, as opposed to, as you mentioned, steering clear of software?
Well, again, I think you have to be selective because memory has been assumed to be in undersupply through 2027. And you saw last week with Google release of their paper talking about how to save and get more efficient on memory by at least 6 to 8 times. Google's already implemented that over a year ago. But the rest of these vendors are going to look at that paper and go, oh, well, these are things we can do to get more efficient. And so it kind of depends on where you are. Now, if you look at microprocessors, going back to what we said earlier, when you have an agent that's going to the SEC website, pulling some data, going to Bloomberg, pulling some data, then using it all, creating a spreadsheet, and then going ahead and querying you on what you need to do, that's not like one task over and over again like you had with training. That requires actually a lot more CPU usage. And CPU demand has been absolutely crushed with the move to AI early on. Now what you're seeing is CPU usage probably is going to go up 2 to 4x from where it was prior to agents hitting the scene in AI. And so I think that's potentially where your new bottleneck is. So for me, the microprocessor vendors are actually pretty interesting, such as an Intel, because they've been sort of given up for dead to some degree as you've moved to GPUs are where you need to be, and NVIDIA. So I think you have to be careful about the stuff that people think is going to be in undersupply forever, like memory, and then say, okay, where's the next area where there may be some bottlenecks, and that looks like it might be CPUs.
And Dan, just a quick question here. We're running out of time. How are you thinking about the prospect of some of these companies going public, whether it's an OpenAI or an Anthropic, and what that can mean for the tech ecosystem from a public equities perspective?
Well, I think it depends on the company again. I mean, I'm not a believer in OpenAI. And I've said that from the beginning, because I didn't think you could spend 1.4 trillion if you're doing 20 billion in revenues and you're going to lose over 200 billion in cash flow until you get to profitability. Anthropic, on the other hand, is focused on enterprise, where companies will pay you for products and they're going to get to profitability sooner. They're more narrowly focused, burning a lot less cash. And so I think it depends on the company and the sequence of them coming public.
Yeah, it'll be certainly interesting to continue to track, and I'm sure we'll be talking about that. Thank you to Dan Niles, the founder and portfolio manager at Niles Investment Management. Now coming up, another investor, Bill Ackman, calling Fannie Mae and Freddie Mac, quote, stupidly cheap after a months-long decline. It's a 2-for-1 stock of the hour up next. This is The Close on Bloomberg. Our stocks of the hour, Fannie Mae and Freddie Mac, both surging after investor Bill Ackman called the mortgage finance companies, quote, stupidly cheap at their current valuations. This comes after a months-long decline in shares amid fading optimism around potential public offerings. Joining us live with more is Bloomberg TV markets correspondent Norah Mulinda. Norah, I fire up the Bloomberg terminal and I see that Pershing Square was the single biggest private sector shareholder of the two companies at the end of last year. Is there anything new from Ackman, or is it more of the same?
Well, I will say that Bill Ackman spends a lot of his time on X really touting the idea of Fannie Mae and Freddie Mac potentially being released from this government conservatorship, which we know has really been going on since 2008. There's been a lot of investors who've been clamoring for them to essentially be released from this and return back to public markets. But there are multiple beneficiaries of that potentially happening. And during the first Trump administration, Trump 1.0, there was some chatter about this potentially happening. But I do believe that Trump 2.0, people really thought that President Donald Trump would come out here and this would be one of his first initiatives. There's been so many other distractions that's going on right now. And it seems as though some investors have really been essentially losing hope. So any sort of commentary that we're going to get from Bill Ackman or any other big name that's interested in them being released from government conservatorship, you're going to see these stocks rally.
For sure, but it is still shocking to see them up this much. I mean, it is not exactly surprising that Bill Ackman, who owns a lot of these companies, thinks that they're super cheap. He would say that. I don't think he would say they're overvalued. But in any case, where are we on that timeline? You mentioned that the administration obviously has a lot to deal with right now. There's been a lot of other things occupying their time. But potentially, where might we land on the path to a potential release?
Well, that's the thing. I think there's a lot of confusion. It still remains very unclear as to whether or not we're going to see some sort of progression in the near term. Some people saying we might have to wait until 2027. So I do think it's really a battle of any sort of volatility. You're going to see these stocks like swing from side to side because any sort of idea that they could be potentially moving forward or any sort of incremental optimism, you're going to see investors, retail traders hopping in on the trade and really trying to see what they can get out of this as people really think about all that they can juice from this trade.
Norah, I'm looking back to your story at the beginning of last year when you predicted Fannie and Freddie would go public late in 2026 at around $31. Just looking at some of the math and some of the expectations, as you mentioned, there's a lot of give and take, if you will, and just thinking through the fact that at the end of the day, these are still OTC stocks. They still aren't technically publicly traded entities where you have kind of a right to the underlying business, right?
Absolutely. And I mean, we are still seeing them trading over the counter. So to your point, not really seeing any rights to that underlying business. But I mean, you, of course, hear Bill Ackman. He's saying that they could be a 10X and that it could happen soon. So a lot of people really just hinging on every last word that he says as they think about what this could mean and who could actually benefit from a return to the public markets officially.
Yeah, it's going to be interesting. I mean, I guess that is the catalyst for this pair of companies, other than, I don't really know. I guess that it's this.
Congress getting involved, perhaps, but it seems as though, at least from the sources that I'm speaking with, that we're a long ways away from that.
All right, Norah, great reporting as always. That is Bloomberg TV markets correspondent Norah Mulinda. Meanwhile, we take a quick check on markets. Just about 15 minutes to go until the close of trading here. And again, it's just interesting to see that dip buying impulse really fade into the close.
It faded, and one of the things that was interesting talking to some investors this morning is how much of this is taking the bait. In that, in the morning, you see a post from Trump saying, "Okay, we're actually making progress. Things are going to be all fine and dandy," and then you immediately see pretty sharp sell-off in the first 30 minutes. And as you mentioned, we're off our session lows, but still well below where we were.
Yeah, it does seem like the shelf life of some of those positive headlines is definitely shortening up here. But we're going to take you to the closing bell next with Ayako Yoshioka. She is Portfolio Consulting Director over at Wealth Enhancement. That conversation up next. This is The Close on Bloomberg.
At about $100 a barrel oil, our estimate is the impact on the U.S. economy is only about 0.2 to 0.3%, and the impact on inflation is only about 0.5% to 0.7%. So those are numbers that shouldn't be, when you're running at 2% plus growth, those are the sort of numbers that derail things.
And that was Jason Pride, Chief of Investment Strategy and Research over at Glenmede, kicking off the show. And Billy, you might have thought that after 5 straight weeks of losses, maybe we would see a bounce day, but you'd be wrong.
The dip buyers disappeared, and we saw earlier this morning that maybe it was going to be a day where oil ended in the green, as did the S&P 500, but not the case. As you can see, S&P 500 down about 0.5%, and keeping an eye on Brent and WTI crude, both trading in the triple digits, though still a $10 spread between the two, Katie.
Yeah, it's interesting to see the divergence really around the world when it comes to energy prices, but it is a proper risk-off day because you have stocks down and yields down, as well as folks bid on bonds. For more market analysis, let's welcome in Ayako Yoshioka, Portfolio Consulting Director at Wealth Enhancement. It's great to have you with us. And, you know, I do wonder at what point we do start to see some of these folks coming in to catch the knife, because you take a look at S&P 500 earnings estimates, they're going higher, valuations have compressed all the while, and we're about to enter earnings season.
Yeah, thanks for having me. You know, when it comes to trying to time this market, it's really difficult. You know, we understand that investors have come off of 3 great years, and whether it is the geopolitical concerns or private credit or the disruption from AI, there's always a reason to take a few chips off of the table. But I think for us, we really want to encourage investors to stay invested and not to time the market. We do think that there are opportunities to sort of rebalance and recalibrate portfolios and make sure that portfolios are just reflecting the risk tolerance of each investor.
If you were to go rebalancing right now, if you were to go bargain hunting, if you will, where do you think the biggest opportunities are right now when you think of just the cross-asset disruption that we've seen over the past month?
Absolutely. So I think for us, we're seeing a lot of opportunities in international and emerging markets, really looking to balance portfolios and create that global allocation for investors. We tend to get a lot of investors who have been U.S. heavy for many years, and rightly so. And so I think taking this opportunity to buy some international and emerging market stocks has been the primary area that we've guided clients.
And if you're making that kind of a trade, would you be recommending clients sell down exposure to likes of a Mag 7, or where would that capital be coming from?
You know, it really depends on the client. We do have some that have been very heavy in the tech sector or in the Mag 7. And so lightening up there is definitely an area that can be the profit center for, investing in international and emerging market stocks. But we also have other investors who, have other areas in alternatives. And we feel like, just balancing it all out for the client is what we want to do.
And the S&P right now is down a little more than 9% from its closing high back in January. Are we getting close to a point where we could start talking about capitulation, or would that really need one further leg down?
I think it's less about the magnitude of, the decline here. I mean, we all get concerned about whether it's a 10% correction and 20% is a bear market and all of these terminology. But, for us, I think it's really about just what is the long-term outlook. I think if oil stays at this $120 level, it really dents EPS by about 4%. And so for us, we think that that's pretty minimal. The tech earnings growth is going to continue. And so overall, you want to stay invested over the long term.
Well, to that point, I hear what you're saying, that, you want to keep your money in this market. You don't want to go fleeing just because of these headlines. But you think about some of the different areas of the market. You mentioned private credit concerns, for example. You think about the traditional bond market. It's certainly been acting up over the past month. And then you think about certain pockets of the equity market. Is there any place within that mosaic where, maybe you would step back a little bit from?
In terms of peeling back exposure, I think for us, it's just balancing out that equity exposure. Sure, locking in some nice bond yields here as bond yields have crept up a little bit is also something that we've talked to clients about. We're not in the era of zero interest rates anymore, and you're actually getting some income. So we're telling clients to lock those in.
And how are you thinking about the knock-on effects of the energy market? WTI right now north of $104 a barrel. Gas prices, according to AAA, right around $4 a gallon. When does that ultimately impact the U.S. consumer, and how do you think about the repercussions from there?
Sure. The consumer has been so resilient for so long. And we've talked about this K-shaped economy in many instances. And we do think that that's going to continue. It really does put a lot of pressure on the lower end consumer relative to the high end, who can sort of withstand some of these higher energy prices for longer. So we'll have to see. I think that's sort of where that repositioning within the consumer discretionary sector is important for us as well. It's something that we continue to sort of guide clients about in terms of how to position within that sector.
And I would also love to hear your thoughts on, how you think the Federal Reserve handles this moment in time. We heard from Jerome Powell this morning making the case that long-term inflation expectations, they remain anchored, that, some of the inflationary pressures that we see right now, it's not that the Federal Reserve would be equipped to handle them anyway. But you add it all together and it does seem like they are in a tricky spot as it comes to whether or not they actually do deliver on some of these rate hikes or rate cuts that are priced into the market.
Katie, you're absolutely right. I think that just ends up meaning that the Fed remains on hold for a little bit longer than we all thought. And so I think those rate cuts are definitely getting priced out, but I think the bar is still relatively high for whether or not those rate hikes need to get priced into the market.
All right, Ayako, great to get some time with you. That is Ayako Yoshioka, Portfolio Consulting Director over at Wealth Enhancement. We are just a couple minutes away from the close. I actually think the bond market is much more interesting than the stock market today because it's doing something that we haven't really seen it do over the past month, and that's actually rally here.
Well, and as you're making that point, Katie, I'm a stocks kind of guy.
I do.
You're speaking French to my English, but I totally agree with that. When you were looking kind of the cross asset flows that we've been tracking really since this conflict, since this war began at the end of February, early March, you've been watching a market that has traded sometimes in lockstep and at times completely aside from each other. Yeah,
definitely. Though I do think that the point that you made at the top of the show, that this is just oil's market. We're all reacting to it in some form. That certainly still applies, and it applies today as we drive towards the close. We know that oil is higher, though to a lesser degree. That's been pressuring stocks, and it's actually flipping the bond market into a rally as we get concerned a little bit here about growth. We're going to break it all down with a global simulcast that's starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
All right, we're about 2 minutes away from the end of the trading day. Katie Greifeld and Bailey Lipschultz in for Romaine Bostic. And here to help take us through the closing bell, it's a global simulcast. We're joined by Carol Masser and Tim Stanovic. We bring together all of our various audiences as we do so. And Carol, you take a look at the market action today. As I was saying to Bailey, you might have thought we'd see a little bit of a bounce today after 5 straight weeks of losses, but those dip fires, they just disappeared.
Yeah, for the most part, right? We're down on the S&P and NASDAQ with just a few minutes to go. Having said that, you did see some folks coming in the last, 15, 20 minutes, half an hour, pulling those major averages off their lows of the session, but still down here, Tim.
So we're in correction for the NASDAQ 100. The S&P 500, though, it's close to a correction. Down from those highs on January 27th, 69.78. Down right now, Bailey, to 63.40. That's about 9.2% from those January highs. So we're on correction watch.
That means my entire team, Tim, will be glued to their seats and glued to their terminals every moment of the trading day for the rest of this week. As they are at Bloomberg. But I also want to call out the fact that the semiconductor index right now, 3 days losing streak, down more than 10%, Katie. We saw semiconductors hanging in there while software was dumped, but right now it doesn't seem to be the case.
Yeah, it's been interesting that it's really the chips, it's really the tech space overall that's been hardest hit over the past month. And a lot of those concerns, they started really in October or so, and they've just been exacerbated since then, Carol.
Yeah, Mag 7, take a look. Year to date, down about 16%. So you're spot on, Katie, in terms of what sectors are feeling the pain this year.
Let's take a look at where we're finishing up on this Monday. Again, off session lows, but still another red day on Wall Street in a holiday-shortened week. The S&P 500 going to finish about 0.4% lower, even more so when you take a look at the NASDAQ, down about 0.7%. The Dow Jones Industrial Average, got to hand it to the Dow, higher by about 0.1%. But what signal can you glean? I don't think there is one. Anyway, the Russell 2000 also lower on the day, even though we did have that big bond market rally, not helping the little guys, Carol.
I just got to say, Katie, the Dow says thank you for mentioning, because it has feelings too.
I didn't want to.
All right, S&P 500, back there we go. Billy, you've got 273 names in the index higher on this Monday, 229 to the downside, 1 unchanged.
Looking at the sector level, you would have thought we would see weakness across any and all big tech, but really your biggest underperformer, biggest drag was industrials, down more than 1.5%. On the upside, though, financials, utilities, and staples. So that kind of a market where investors are avoiding riskier assets.
All right, so let's go to some of the individual gainers, if I may, in today's session. And I got to talk about Fannie Mae and Freddie Mac, because these were on a tear today. Shares of Fannie and Freddie pairing a month-long slide after Bill Ackman, who has bet heavily on the companies, called the mortgage finance giants stupidly cheap.
Surprise.
Carol, is it different than what he was saying a year ago?
I know.
It's almost like he has a stake in it.
Yeah, right.
It's like, but listen, look at it. It's crazy. You got what? Fannie up 51%, Freddie Mac down up about 47%. Keep in mind, these trade over the counter, they tend to be volatile. We often see this. So steepest jump since I think about May of 2025. But you're right. Ackman's Pershing Square Capital Management was the single biggest private sector shareholder of the two companies at the end of last year. That's according to our data here at Bloomberg. Over the weekend, Ackman, who's been pitching the White House on plans for releasing the companies for government control, said in a post on X that Fannie and Freddie offered asymmetry at its best. They could be a 10 times, and it could happen soon. But, you talk to some other folks who say these folks as public entities, maybe not such a good idea. So two sides to every coin. All right, let's take a look at aluminum stocks. U.S.-listed aluminum stocks gaining after a rally in the metal price following Iran's attacks on Middle Eastern aluminum facilities played out. So take a look at names like Alcoa. It was up about 8% in today's session, more than 7% gain for Century Aluminum. And then Rio Tinto up about 2.5%. And then we did have J.P. Morgan analyst Bill Peterson putting out a note to clients. He said, while sentiment and positioning may drive further volatility, the fundamental risk to supply outweighs demand destruction for now, making the outlook for aluminum notably bullish amid heightened geopolitical and logistical uncertainty. So investors took note and said that whole space higher today, Tim.
Well, the whole space that was lower today were semiconductors, as Bailey mentioned just a few minutes ago. I want to start with Micron, down another 9.9% today. Memory and storage companies extending their recent slide. Remember, it was last week that the entire group came under pressure. This was after Google talked about that breakthrough that analysts say may curb demand for certain types of storage. The reason I'm picking on Micron, though, is because it's down more than 30% since March 18th. That's when the company reported its most recent earnings. And that's when it said it would have spend more on CapEx this year than analysts wanted to see. It has been on a slide since then.
Tim, it's still up more than 270% on a 12-month basis. I'm just going to call out the winners in the long term.
Okay.
Wow.
We'll see what happens tomorrow.
There's two sides to every trade.
We'll see what happens tomorrow. Thank you for the additional context. Appreciate it. Hey, also in the S&P 500 falling today, let's go to Boston Scientific. BSX is the ticker. Down today by more than 9%. Shares tumbled after results from the company's trial of the Watchman heart implant fell short of investor expectations. The trial studied patients with non-valvular atrial fibrillation. It's a heart rhythm disorder. The trial did meet all preliminary and secondary safety and efficacy endpoints. Still, though, investors said it fell short of expectations, or analysts, I should say it fell short of investor expectations. And finally, a little M&A on this Monday. Taking a look at shares of Cisco. This is the food company, not the, tech company, down more than 15.2%. SYY is the ticker. They're acquiring Jetro Restaurant Depot for $29.1 billion. That includes debt in a deal that will create one of the largest food service groups in the U.S. Cisco plans to raise about $21 billion of debt to help fund its acquisition of the closely held Jetro Restaurant Depot. That's according to a statement on Monday. The financing would also include hybrid debt, as well as $1 billion of cash on hand equity or equity-linked securities. Once again, Cisco, the food services firm, down by more than 15% today.
All right, let's take a quick look at yields here. What happened in fixed income? And we saw a big rally across the curve, as you can see, down 7 to 8 basis points. The 30-year down about 5 basis points. We heard from Jerome Powell earlier today. He did say that longer-term inflation expectations remain in check and that officials may need to respond to the impact from the Iran war. Not the case yet, but they may need to respond. So you add it all together, it seems like the market flipped from being really concerned about inflation, or at least the bond market, that concern about inflation flipping to concerns about growth expectations, and finally seeing a bit of a rally here, though I will mention that the absolute levels on these yields much, much higher than where we were a month ago.
All right, guys, it's time to improve your aura points.
What does that mean?
I don't know what that means.
I think we're the youngest people in this chat, and I have no idea what you're talking about.
I don't know. It's something about like your social standing, doing some like cool things. Anyway, you can actually do some aura farming or mogging. I don't even know what that is. There's also mall maxing. Apparently, teens are putting down their phones. I feel really old.
Cheryl, none of those were words. I just want to go ahead and say, just to be clear, for any viewer or listener, none of those are words.
Just add it to the dictionary.
It's just time to go back to the mall. Apparently, kids these days are going back to the mall. They're getting their ears pierced, buying jewelry, trying on outfits. But what I don't understand is that they're still then posting this on socials, which then says to me they're picking up their phones.
I'm glad you said that, because the whole reason that some of these places are now popular is because of the TikTok feedback loop. So it's actually supercharging teens' obsession with going all in on anything that catches their fancy. That's what's called maxing, guys, okay?
Right.
Okay.
Influencers post from stores, they show off their shopping bags, so they want to do the same. The friends see their posts, they want to go to, and so on. So
you don't need any more aura points. That was pretty cool.
I will say, we have been talking about it a bit on the close. I don't think I've ever heard Romaine say aura farm, but we have been talking about it from a real estate angle. You know, if you think about real estate investors, they're psyched that the mall is back. How about space, though?
Oh.
How about the moon? Because in some ways that's back as well. On Wednesday, April 1st, NASA is going to send a crew of astronauts around the moon for the first time in more than 50 years. I think this is fascinating. And you think just about the training that these astronauts have to go through. It's pretty wild to think about.
Yeah, and Katie, it's a 10-day journey, the second flight of NASA's Artemis program, to help Tim create a lunar outpost as a stepping stone to Mars. So if your eyes are set on the moon, Katie, Mars is just a little bit further, is what I've been told.
Yeah.
Much better than mall maxing. That's a lot of aura points. I'm just going to say.
Definitely. Only if you post about it, though. That is the key point. It's great that you physically went there, but you can't aura max if it's not on your socials.
Nothing, Tim?
no, I told us to wrap.
He actually listens.
I listen.
He does listen.
Yeah.
All right, that is a wrap. All right, our cross-platform radio, TV, YouTube, Bloomberg Originals. Do you think we got any aura points there?
I think we're losing points every second that we keep going.
All right. Katie, and of course, Bailey continuing there on the close on Bloomberg TV. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow.
And coming up, Fed Chair Jerome Powell saying today that he's confident that longer-term inflation expectations are in check. We'll ask Esther George, she is former president of the Kansas City Fed, what she thinks next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Bailey Lipschultz. Let's take a look at where markets closed out the day, Katie. The first red Monday for the S&P 500 since the initial attacks on Iran. S&P 500 down, as you can see, about 0.4%. We're seeing U.S. 10-year yields at 4.35%, a long way away from the 3 handle that we saw at the end of February. And keeping an eye, Katie, on both oils. WTI crude right around $105 a barrel, and Brent crude, the one that really matters over in Europe, heading towards $115 a barrel. A lot of bad pain, Katie, in a market that is really driven by what the energy futures are doing.
Well, you've heard of Black Friday. Now you've heard of Red Monday as well. Let's talk about why it was so red. I actually put some good news up at the top because I thought we needed it. Meta higher by about 2% on one of the final trading days of March, a March which has been absolutely terrible for this company, but still Meta rallying a little bit today. I cannot say the same about Micron, down another 10% or so. This company actually in correction territory at this point from when it reported earnings earlier this month, and certainly those woes piling up today. And then Cisco, we were also talking about this with our radio friends. It is a little bit of an M&A Monday, and you can see that Cisco, which is in talks to acquire Jetro, down about 15.3%. But let's get to our top story this hour, and that is the U.S. bond market rallying back from its deepest sell-off in 17 months as traders ditch wagers that the Fed will actually hike rates. Traders pricing back in the chance of a cut this year as the focus now shifts to speculation whether the war will deepen the economic slowdown. We've heard from some of the biggest bond fund managers, from PIMCO to JP Morgan, saying that basically this market is underestimating the risk of a slowdown. Goldman Sachs adding to the din here, warning about the probability of a downturn over the coming year that, in their view, has risen to about 30%. Let's ask Collin Martin. He is head of fixed income research and strategy over at the Schwab Center for Financial Research. And Collin, it really feels like some sort of switch was flipped. This handoff from worrying about inflation sending yields higher to now the market seems very concerned with growth prospects sending yields lower. I wonder what you think the proper reaction function is right now.
Yeah, we think there's risks to both sides. And I think it makes sense that over the first 4 weeks or so, it was an inflation story. But I do think the longer that the conflict goes on, like we're seeing right now, that we're in week 5, I think the negative consequences of the war are going to trickle their way into the economic outlook. And I think that makes sense today. If you're looking at the movement in the bond markets, Treasury yields down, a pretty good amount on a day when the price of oil was up. So, that should result in higher inflation, yet we're seeing the opposite happen. I think if we go back a few weeks to that Fed meeting, if we look at most of the questions that Powell got at the press conference, a lot of them were focused on inflation. And if you look at the big level, the high level points of the summary of economic projections, it painted a relatively rosy picture of the economy, which tells us that, and that was probably a pre-war projection from a lot of committee members. But if you dig deeper into that document, you can take a look at how the committee is looking at the balance of risks. And they have a few diffusion indexes back there. And I don't think that has made enough headlines, where if we look at the risks to both the inflation mandate and the growth or labor market mandate, there's risks to both sides. And even though we're concerned about the rise in inflation, that's where the focus of the Fed meeting was. If we look at the committee members and participants, how they're viewing the risks, to the downside risks to economic growth, that was high as well, but that just didn't make a lot of headlines. So I think this makes sense. We're not expecting a recession in the near term and a huge plunge in Treasury yields, but there are 2 risks out there right now.
Yeah, absolutely. And I wonder, how you think that should be expressed along the yield curve, because it's been interesting to see some of the reaction when it comes to, how the curve has sort of been trading the different sort of function at the front end versus the long end.
I think over time, we'll probably see yields come down, at least on the short end. I think the expectations for rate hikes became a little bit overblown. And we saw that today with, if you look at the WRP function on Bloomberg, it's back to a negative sign for the rest of this year. I think that makes sense. The bar for a hike seemed really high, given the state of the economy where we are today versus where we were a few years ago. In the labor market, stable, but a little softer than it's been over the past few years. Inflation not as high as it was back in 2022, for example. And I think if we do start to see those negative consequences, that could give the Fed cover later this year to maybe cut rates. I say maybe because I think they're probably on an extended pause for now. But I think the risks, again, if this goes on for a while, we will see that negative impact, especially if you see gas prices near $4 or so. That's a big jump. And the longer that goes on, that's just more money out of our consumer pockets.
Yeah, Collin, you make a great point. And one of the things that I'm interested in keeping an eye on as it relates to economic data, JOLTS release, employment situation, we get a big update or a couple big updates this week. How important are those data points? And I guess to your point, when we're thinking about the ultimate impacts of inflation, of the ongoing war, is it just a part of the equation that really plays kind of a backseat role?
Yeah, it is part of the equation. The challenge right now, and as we're coming up with our outlook to our Schwab clients, is how do we balance the economic outlook and fundamentals with the uncertain nature of the war? And it is admittedly a challenge. But we do have, a pretty heavy week of economic data. We have JOLTS tomorrow, but that might not be too important because it's from February. So that's kind of old news by now and not taking into account any of the effects of the war. I think the March payrolls report will be important, even though it doesn't account for the whole month. We'll get an idea of how companies were hiring or firing over the course of the month. We'll be focusing on that unemployment rate, hoping that it stays around that 4.4% level that we saw last month and what the consensus expectations are. But I think equally important is the ISM manufacturing index. That's a survey of businesses. So just like with the payrolls report, where it takes into account part of the month, we'll get an idea of how businesses were dealing with the uncertainty, if it was impacting their hiring plans, their ordering plans. So I think all of those, we're finally getting an impact and a look into what this all means to the economy and how that will translate to growth, strong or slow over the next few months.
Well, you make a great point, and one thing I want to come back to is what the economic picture and what the employment picture looks like when we're still seeing or at least dealing with the potential repercussions of a broader rollout of artificial intelligence and how that could impact jobs. So how are you thinking about that?
Yeah, that's one piece of the puzzle, just like we're looking at everything together. When we look at the labor market right now, at least personally, I focus on the unemployment rate and household employment more so than I'm looking at the monthly payrolls data. When we're this late in the cycle, we're going to see ups and downs, and it seems like we're in this low fire, low hire period. We want to make sure we're not seeing a pickup in fires though and layoffs. I think that's where you might start to see the impact of AI come in. So far, we haven't seen that too much. Again, it's been pretty volatile if you look at the monthly payrolls. If you look at initial jobless claims, they're still relatively low right now, but it is a risk down the road. But for now, we think it's kind of holding steady.
And Collin, before we let you go, I do want to talk a little bit about what we're seeing on the corporate credit side of things, because you take a look at spreads, not too much reaction relative to some other markets, but high yield bond spreads, for example, a little bit more movement there. Do you think that there is more runway for some of that widening, or is corporate credit well insulated here?
Probably a little bit of both. I think high yield credit is somewhat insulated, and that's what we've been telling our clients, where the leveraged finance markets have evolved a lot over the years. And if you look at the high yield bond market, it's relatively highly rated within the realm, within the scope of it being junk or sub-investment grade. 55% of the index is double B. So we think it's relatively well insulated, but that doesn't mean there can't be spillover effects. And where we see spreads right now around 3.3% or so on the broad high yield index, we saw a big jump at the end of last week, and it's up about 80 basis points or so from the January low. One thing we look at, Katie, is that break-even spread. How much spreads would rise and then hold there over a 12-month span where excess return gets wiped out, where the actual spread gets wiped out. It's usually around 100 basis points for high-yield bonds. So we're pretty close to that from those January lows. And that's a challenge for investors when they see those potential declines relative to treasuries. But we do think there's more risk out there, especially if we get headlines about redemptions, even though I think it's very different comparing public high yield versus private credit. The headlines itself can cause some concern for investors. And I think maybe we see spreads continue to rise. Right now, we're neutral. We think volatility could pick up. But if we see a rise to maybe 4.5% or so, high yield would probably become a bit more attractive.
Yeah, we've got to leave it there, though. Thank you so much, Collin Martin of the Schwab Center for Financial Research. Well, Well, coming up, the biggest IPOs of the year and potentially ever could be on a fast track to the NASDAQ 100. More on that after the break. This is The Close on Bloomberg. Well, we're gearing up for a potential blockbuster year for the IPO market, and that's fueling an index rule rethink. The NASDAQ set to slash the time it takes for newly listed large cap companies to enter its main index from 3 months to just 15 days of trading. Here to discuss is Isabelle Lee. She is a Bloomberg cross-asset reporter. Isabelle, walk us through how this potentially changes the game for SpaceX, OpenAI, and Anthropic.
So this is obviously noteworthy. And on May 1st, that's when they'll enact the change. So to your point, from 3 months, roughly, it'll be 15 days. And obviously, we have critics who said anything less than 30 days is too short because you're not going to allow for price discovery. You're going to cause a lot of volatility. And what if these companies are low float and all those concerns? Just an FYI, FTSE Russell's doing a rethink also, and theirs, it's 5 days. S&P is also doing a rethink, according to Bloomberg News. And for now, theirs stand at 12 months. So you can just imagine how shorter and shorter it's becoming. So that's the critics. But we have a lot of advocates who are saying, yes, we want this, because what if SpaceX is listed and you track the QQQ with the NASDAQ and you don't have SpaceX there? So they want it to be more reflective of what's in the market.
Right, yeah. I mean, it was a pretty heated debate in a certain pocket of Wall Street in the index world. Give us a little bit more of the issuer or the index provider side of things, because you have the critics, the advocates, and then you have the issuers. I keep thinking about ETFs. The index companies themselves, who I imagine, are sort of vying here.
They're caught in the middle because, on one hand, I mean, this goes to core of what we cover in our team, which is what is passive? Is passive just really mechanical, rules-based, or does it involve human decisions? But this isn't really unprecedented. In the past, issuers, Katie, index providers. Index providers have adjusted rules to reflect what's happening. And again, to Bailey's point earlier, this is something we've never seen before. This year we have potentially SpaceX, Anduril, OpenAI. I mean, the list goes on and on.
Well, the big thing, though, when I saw this news from you and Lou, my immediate question was, how important is it in the NASDAQ 100? Because most active managers are, benchmarked against the S&P 500, whereas the Qs are a cool retail product, but it's not really the gold standard, or is it?
They won't be happy to hear that. The NASDAQ 100 is directly benchmarked to around $600 billion. So that's still something. But yes, you're right. More than 30 trillion in assets are benchmarked to all three with indexes under consideration. So it's really huge. And this is the core of what being an American is, or investing in low-cost index funds, that you gain access to these companies, even with dirt cheap fees. So it's really an interesting thing. And Russell, we're still waiting. They will release theirs on April 3rd.
Yeah, so that's coming up here. I have to imagine that maybe there's a few active managers who are a little bit salty about this change, because, I mean, if one of the biggest companies out there isn't in the index, isn't in the NASDAQ 100, maybe you actually have a shot at beating it for once.
I know, and then we've been tracking the ETFs that track SpaceX or a lot of these private companies, and now yeah, they'll be just like everyone else. But a quick thing, though, with the NASDAQ 100, they did say that they won't necessarily drop one if they add one, at least not immediately.
Well, because the thing that's been interesting tracking the IPO market is, does this ultimately mean to an extent that NASDAQ is going to win the listing versus NYSE, just because to be listed in the NASDAQ 100, you have to be on the NASDAQ?
That's a great point. Reuters broke this story.
Oh.
Unfortunately, but Reuters said that that was one of the poker chips that Elon Musk used to list in the NASDAQ to have this fast entry.
Well, you've seen several companies do that in the past year or so. Walmart, Palantir switched their listing solely to get into the NASDAQ 100, or main motivating reason. Isabelle Lee, great reporting as always. That is our cross-asset reporter over at Bloomberg. Now, coming up, Powell easing Fed hike jitters. We'll discuss next with Esther George. She is former president of the Kansas City Fed. This is Bloomberg.
Energy shocks have tended to come and go pretty quickly. Monetary policy works with long and variable lags, famously. And so by the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone, and you're weighing on the economy at a time when it's not appropriate.
That was Fed Chair Jerome Powell speaking at Harvard earlier today, saying that the central bank has little control over supply shocks. Joining us now is Esther George. She is former president of the Kansas City Fed. Esther, great to have you with us. And you think about Powell's comments there that, when it comes to supply shocks, such as what we're seeing when it comes to what's going on with oil supply, he's right that, the tools that the Fed has at their disposal might not necessarily be the proper ones to sort of address the inflation that might accompany that. But still, you think about this moment in time, which do you think seems to be the more urgent risk here? The idea that inflation might pick up, or this could have real knock-on effects when it comes to economic growth?
Yeah, this is such an interesting and I think most challenging time for the Fed, because you really have to worry about both of these things together. And I think one of their challenges is figuring out the timing of this particular episode and how long this might last. And so remember, inflation has been running well above their target now for 5 years. And now they come into a shock that has an upside risk to that inflation. And so they must be very attentive to that. At the same time, we know that if this persists, that it can have downside risk for growth and the labor markets. And so both of these things squarely in focus for the Fed right now, and difficult to interpret until more time passes or some more definitive event takes place that lets them know how they should respond.
Well, you think about that 2% goal. Jerome Powell did bring that up, that 2% inflation target that the central bank has, saying that he needs to see more evidence that inflation is moving towards that 2% goal before policymakers would consider cutting rates again. Again, you think about where we are in terms of this oil supply shock, the fact that inflation has been pretty stubborn at around 2.5%. When you add it together, it seems like this Fed could be on hold for a while here.
Well, I agree. And I think part of the issue here is there was a question about whether the rates at the current level were restrictive. And we've heard in past meetings various iterations, whether modestly restrictive or moderately restrictive. I think what we're beginning to see is even at these rates, inflation is not coming down in a convincing manner the way the Fed would like to see it come down. And so that current state, even before the war began, now with the prospect of energy shock, higher pressure on prices here, I think now it has to be squarely in focus for them to sit tight and not to act on the forecasted cuts that appeared in their SEPs, but to really watch carefully how this is going to unfold. Because I heard the chairman say here, and I think it's right, you don't want to react to something that you think is temporary. And of course, we went through that experience during the COVID episode. So I think lessons from that and watching carefully now will make them be very attentive to what's happening with inflation.
But what would make you think the Fed should be in a position to hike if this war continues to drag on, or is it something else from the economic data that would completely cause the narrative to shift entirely?
So I think a couple of things they'll have to watch for there. One is, are you beginning to see the inflation broaden out? Is it really just an energy shock story? Is it just the price of gas at the pumps? Or is it going to begin to spread out in a broader way? Remember, again, that's what happened during the pandemic period. We began to see more and more prices experiencing that. The second thing, of course, is something the Fed looks carefully at, and that is, what is the market expectation? What are household expectations for inflation in the long run? Those have remained a bit elevated, in my view, and have not come down convincingly to that 2% target. And so while they're not unanchored by any sense, I do think watching carefully the breadth of inflation and those inflation expectations are the real keys to what the path is going to be for an inflation concern.
And when you think looking forward, again, it's impossible to predict the ultimate end to the war and the ultimate end to the conflict and the knock-on effects. But is there an expectation, in your view, when we could see a more normalized, a firmer footing for the Fed to act kind of judiciously with this fully in the rearview mirror? Are we on pause, even if it's addressed in the coming weeks or coming month, through the summer and into the fall, in your view?
Yeah, unfortunately, I think these things play out longer than we might expect. I think even if the war would wrap up quickly, you are going to have knock-on effects that come from the supply disruptions for things to begin to normalize. So I think it will be later into the year before you would begin to see things normalize. Certainly, if the war extends into the summer, it will just push that time frame out. So I think it's fair to say, absent some unusual event here, unexpected event, the Fed is going to just sit tight, I think, and wait to see what shows through in the data, how much of that is unique to this war, and how much of it might be portending broader impacts to the economy.
And Esther, in addition to your time at the Kansas City Fed, you also served as the Fed's acting director of banking supervision and regulation back in 2009. And with that in mind, I'm very curious to hear your perspective on what's going on in private credit. We heard from Jerome Powell today saying that it's a situation that the bank is, quote, watching super carefully. But at this moment, they're looking for connections to the banking system. And in his view, right now, they're not necessarily things that might be destabilizing. I wonder from your perch what you're seeing unfold there and whether or not, there are meaningful risks that could be posed to the banking system if this develops further.
Yeah, my own view, having watched how this sector has grown and grown rapidly over the course of some years, you do see quite an intersection with the banking system. So private credit is relying heavily on the banking system for funding and liquidity that's provided there. So in that sense, it is really incumbent on the Fed to watch carefully, as the chairman said, to see where those vulnerabilities might emerge. At a time when the Fed is also looking at deregulation, is looking at lower capital requirements, those are the conditions in which you want to look carefully at where weaknesses, where particular triggers to those vulnerabilities might emerge. So it's something to watch very carefully right now. I think the Fed has noted that in their financial stability reports that they publish, and I would agree with that. I think when you have a part of the market that is less transparent, is less clear how the structures are in place, that connection to the banking system becomes ever more important to monitor.
Well, Esther, always appreciate your time. That is Esther George. She is former president of the Kansas City Fed. This is The Close on Bloomberg. Well, the war in the Middle East starting to weigh on global growth, with the OECD and the IMF estimating a slower path forward for the world's GDP than they did before the conflict. Our next guest has been advising C-suite executives on how to navigate their businesses through this conflict, which is now entering its 5th week. Joining us in studio is Kevin Kajiwara. He is Global Chair of Political Risk Advisory over at Teneo. Kevin, first off, great to see you.
Hi, Katie. Good to see you.
I was looking at when the last time we spoke was. It was on March 2nd, almost exactly a month ago. And here we are, nearly a month later, and it seems like the situation has only intensified. Those 3 to 4 weeks have turned into another 4 to 6 weeks. And now we're potentially talking about troops being deployed here.
Yeah, absolutely. And I think the other major difference is, at the beginning, the Strait of Hormuz, which has been blocked, mostly this was about product on the wrong side of that strait, unable to get out, which has been ongoing. But now, in addition to potential ground troops being introduced into the equation, you're seeing real attacks on industrial infrastructure. So, for instance, the Iranians struck aluminum facilities this past weekend as an example. So, you're starting to see that price effect in markets beyond the energy markets.
Absolutely. And you identify it's not just about the flow of oil, even though the Strait of Hormuz being closed is a big problem. The fact that infrastructure is being damaged as well. The way that these effects compound, it's not linear. It's much more dramatic than that. So you think about how that has sort of affected the conversations in the C-suite. How does that change the tone?
I think now, there had been a lot of assumption that perhaps we could get through this conflict quickly. That was certainly what the White House was suggesting, as well as the Pentagon. But I think now you're starting to see CEOs be concerned not just about the longevity of this, but they're really starting to think about the second, third, and fourth order impacts, not just on energy prices and therefore, transport costs and the like, but, so many industries dependent on product that's coming out of the Strait.
And when we think about the knock-on effects to the entire supply chain, when you're meeting with management teams, how are they thinking through, do they need to raise prices? Are they thinking through paying up to acquire goods because of the uncertainty around the duration and how much longer this can go for another 4 weeks?
Yeah, I mean, I think the number one thing, Bailey, that they're trying to do is to kind of scenario plan out how this might play out, because as yet, given what I was just saying to Katie, there's not great certainty about what the duration is going to look like. And quite frankly, it's not just when this ends, it's how it ends, right? Is the Strait opened in an unfettered international channel the way it had been for years past? Or is Iran going to maintain some sort of control, in which case they could come in at any time and effectively close it, and therefore a new, let's call it permanent risk premium needs to be applied. So in other words, CEOs, I think, are thinking through all of the ramifications of this and increasingly asking, kind of similar to the conversations we were having last year regarding, say, rare earths and China's ability to turn them off. What are the other key choke points, be they physical or just control of commodities and the like, that puts them at potential risk longer term?
We see markets reacting to every headline, every social media posts. In the C-suite, are they reacting that quickly, or is it more of a wait until there's actual fundamental changes in this ongoing war?
I mean, I think you're absolutely right that there's a lot of headline chasing that's going on right now. We've seen that even just this morning. In fact, the C-suite has to take a little bit of a longer view and not be led around like that. But at the same time, they're not ignorant of that, of what's happening. And, for instance, this morning, right? I mean, we have seen just in the last week this kind of shift from Fed watchers assuming that there was going to be, say, no rate cut after thinking there would be two over the course of this year prior to the war starting, to today shifting back to now being more concerned about growth prospects than they are about inflation. That is definitely going to be playing into the production schedules, what the supply chain is going to look like, et cetera.
And it's interesting, I'm taking a look at the notes you send over to our producers talking about how markets typically price wars, and the long of short of it is they don't. And, I keep thinking back to this conversation we had on The Close with Amos Hochstein on Friday, a former advisor to the Biden White House, basically telling us that the market is pricing risk, it's not pricing disruption, and it should be. And I just wonder, when you're having these conversations with some of your C-suite clients, I mean, is there that same urge to not jump to the worst case scenario, to not think about, this is a big disruptive event versus, this is just something that we're looking through right now?
I think a lot of it is keeping people's eyes open to the fact that the logic of sort of Western business can't necessarily be applied here, right? And that actual lasting damage is something that we're now contemplating. So this is not going to be something where the Strait reopens and there's an immediate return to normalcy. Decisions that are being made now are going to have longer term, are going to have long-term ramifications.
All right, Kevin, always wonderful to see you. That is Kevin Kajiwara. He is Global Chair of Political Risk Advisory over at Teneo. Let's keep the conversation going now, because President Trump threatening further escalation of attacks on Iran as the fifth week of war jolts global markets. Bloomberg's own Anne-Marie Hordern spoke with the president briefly over the phone, with President Trump saying, quote, they want to settle. Joining us now is Puneet Talwar, former U.S. ambassador to Morocco and former senior Iran advisor to President Obama. So, Puneet, I mean, you think about where we stand right now. There's been the word ceasefire thrown around a lot over the past week and a half. But we also heard from the president saying that if we don't see the strait opened, if we don't see a deal with Iran, that strikes on their energy infrastructure is coming up next. We know that the U.S. has said that they're going to pause those strikes until a week from today. But it seems like the idea of a ceasefire and a quick end to this conflict is getting further and further away.
I think that's right, Katie. If the president were to follow through on the threat that he made today, I think the consequences of that would be to really expand and prolong this war. I think that Iran would be very likely to respond to that by striking at energy and water targets throughout the Gulf region. And you could end up in a situation where you have a humanitarian disaster with millions of people without access to water or electricity. Now, I think the president made that threat in order to try to build leverage for potential negotiations, which he says are proceeding, and I hope that's the case. From what I've seen in the public reporting, I'm really concerned, actually, that there are some challenges to diplomacy here. And I also believe that Iran perceives that it actually has the upper hand. And when it hears these kinds of threats, it believes a strategy is working. And why does Iran believe that? It's because they have a very different definition of winning here. They believe they have survived a very ferocious assault. They continue to have a stranglehold on the global economy with the Strait of Hormuz. And they're able to launch retaliatory strikes against their neighbors.
Well, I am curious. I mean, you mentioned a lot there to dig into, and President Trump did say that the U.S. is possibly looking at desalination infrastructure as well. But when it comes to the idea of diplomacy in this situation, we also heard from Press Secretary Caroline Leavitt earlier today saying that the U.S. is not sure who is in charge of Iran. Given, your time as a senior advisor when it comes to Iran, how would diplomacy even be possible in a situation like this? If we're still trying to figure out who is actually in charge of the country that we're trying to talk to.
Yes, and we had some of these debates as well early on in the Obama administration. And at the end of the day, this is really a system. Not that system, through the course of this conflict and the leaders that have been basically eliminated, they've been replaced by even more hardline individuals and more radical individuals who are very skeptical of diplomacy. We don't know the condition of the new supreme leader, the son of the late supreme leader, Mojtaba Khamenei. The president has said we don't know if he's alive, if he's injured, what his status is. Now, that said, Iran is continuing to make decisions, and we see that in the way that it's executing operations. I think we can assume that there is a group of individuals, as there always has been, in this leadership structure. And now that leadership structure is heavily skewed towards the radical Islamic Revolutionary Guard Corps. So I think you can have diplomacy in this situation, but I think it's going to be very difficult. And it's not just that the positions are very far apart. You have a paradox. Even though the United States and Israel have destroyed thousands upon thousands of targets in Iran, Iran, again, still believes that it has the upper hand because it has survived that assault. It has a stranglehold on the global economy and is continuing to launch attacks against neighbors. And so the positions that have been put forward, the 15 points that was reported in the press that the president put forward, and Iran's 5-point response are sort of maximalist positions. And so there's a lot that you could do to get diplomacy on track, I think, but we're not there right now. And the first thing really would be to have more realistic set of priorities that one goes into for the negotiation.
Yeah, and it'll certainly be a dynamic situation that we continue to track. So thank you so much for joining us. Puneet Talwar, he is a former senior Iran advisor to President Obama. Katie, obviously, the kind of unfolding of this war has been closely tracked. When we were talking 2 weeks ago, it seemed like at least the end could be on the near-term horizon. Here we are 2 weeks later, and it still continues to be something that we're tracking with. Will there be troops deployed? How does that ultimately play out? And ultimately, can you reopen the Strait of Hormuz in a way that gets goods flowing without escalating tensions?
That's the thing. I mean, so much of this hinges when it comes to the market response on what happens with the Strait of Hormuz. You think about how those effects compound, as we were talking about with Kevin Kajiwara. It's not linear. It's just more and more dramatic as time goes on. And it's not just oil. You think about fertilizer as well as other energy markets, certainly a broad reach there. But still ahead on this program, we're going to walk you through what investors need to watch for over the next 24 hours. This is The Close. Let's take a look ahead to what else we're watching for over the next 24 hours. We have plenty of earnings kicking off pre-market with McCormick. Bailey, they make spices.
They are the spice king, but they also could be in talks to buy Unilever's food division. So it'll be interesting to see if anything comes up on that topic on the earnings call.
Yeah, absolutely. And then after the bell, you'll be with me, thank goodness, because we're going to be talking about Nike and RH also reporting. But before we get there, at 10 a.m. Eastern, we do get Conference Board consumer confidence, as well as JOLTS, a little bit of a preview of Friday's Fed, or not Fed report. It's a jobs report. It's a market's closed, though.
Market's closed, but we get economic data, which matters for the Fed, except for there is a war going on.
Right, for sure. We also get some Fed speak as well. We heard from the big man himself today, Jerome Powell, but we'll also be hearing from Goolsbee, Barr, Schmidt, and Bowman in the next 24 hours as well. There's certainly a lot to talk about. But coming up next, don't go anywhere. It's all of your politics coverage you need to know with Balance of Power.